Okay, problem 10 is just a little bit different, and I want to work on this because people tend to think about adjusting taxable income, but you also have to adjust for taxable loss. So at the beginning of the year, this company has a $220 million loss for financial reporting. That includes a penalty of $15 million. Well, we have to add that back because that penalty is never going to be considered for tax purposes. So our loss at this point is 205, and that 205 includes this 30 million from accruing a loss contingency. They had a loss and they set up an allowance account so they have the money to pay it when it comes due. So for tax purposes, we have to add that back as well. We'll pick that up later, but that'll give us rise to a deferred tax asset. So our loss, our actual loss, our taxable loss is $175,000. So this company wisely is going to carry this back 2 years to write off $110 million and $35 million in income to get those tax refunds now, because if they're running in the red, they can use the cash. And that gives them $145 million that they're going to write off. So they're going to use $145 going back. They have $175 total. So $175 minus $145, they're going to have a $3 million net operating loss carry forward. So let's see what they're going to get coming back at them. So they're going to get their 40% of this and their 40% of that. So what's that? 44 million and 14 million, 40% of 30, 14. Okay, so they're expecting a $58 million tax refund. That's a receivable, debit receivable, $58 million. Okay, now their total deferred tax asset going forward, they've got what? 30 for the net operating loss carry forward, and 30 for the DTA for the contingency, for the allowance that they have to bring in. So they have 60 million total of deferred tax assets. So if they're subject to a 40% tax rate, that puts them at 24 million for deferred tax assets. Now, this is a little different because what this is doing is this is lowering our taxes. So we credit a thing called income tax benefit. I have also seen this credited to income tax expense for the total of 82 million. The next thing it asks us is what is their net operating loss total, okay? So let's figure that out. That's the middle piece and the bottom piece. So what is their net operating loss reported in 2013? Remember, they've used up a good part of this to generate this receivable, okay? So their operating loss at the beginning was 220. Now this is their income statement. So this includes the deferred tax asset that's allowable in there. The fine is allowable in there. So we have 220 total loss, but we offset it by our credit to previous tax expense or to tax benefit of 82. Okay? So that reduces our operating loss for 100 to 138. It's an actual increase. We've actually generated basically income by making claims against previous taxes in terms of this. That's going against previous taxes, and this is going against future taxes. In either case, they will end up reducing our tax expense, so that's a credit to income tax benefit or a credit to income tax expense. There, you can use them interchangeably. The last piece it asks us is to prepare the journal entry in 2014, okay? Assuming the pre-tax income is 95, and we're going to be using up that contingency because that came to pass, and we're going to use up what's left of our NOL carry forward. So, let's take a look. Our pre-tax accounting income was $95 million. We have our loss contingency of 30. That happened this year, so we can reduce our income by that for tax purposes. We have our NOL carry forward of $30 million. We can carry that forward. So our taxable income for this year is $35 million. Okay, so that's our taxable income so far. Now 40% of that gives us a tax payable of 14. So that's our tax payable, 14%. Now let's take a look at what else we have. The deferred tax asset we used up. Okay, we've used up that $24 million of the deferred tax asset, and our income tax expense is the total 38. What you had to do is you had to remember that we used up this 14, okay, and this gives us that, and these two combined as a plug gives us that.